I know we get a lot of clients, and we talk a lot as a firm as we get towards the end of the year about tax saving strategies. And another one we want to talk about today was tax loss harvesting and how we help clients with that, how we navigate markets with that, and just throughout the year as we've been doing different trading. Can you talk a little bit about the strategy we have here at Instrumental Wealth and just our philosophy around what we do towards the end of the year for tax planning in regards to that?
Yeah, absolutely, Drew. Happy to tackle it. Yeah. So tax loss harvesting is essentially a strategy that we deploy here at Instrumental Wealth where, and it's not just at the end of the year, it's the end of the year. Obviously, we put a little bit more emphasis on it. But essentially what tax loss harvesting is looking at a client's investment portfolio and determining what positions are at a loss and intentionally selling those securities that are at a loss to realize the gain for tax purposes so that the client can ultimately then have a loss carry forward for going forward in the future to offset future gains, or they can take up to a $3,000 deduction against their ordinary income in that year. And in essence, what we're trying to do is use the tax code to our advantage by moving into another asset that is not the same asset as they just sold to not violate what is referred to as the 30-day wash sale rule. In essence, the 30-day wash sale rule says that if I sold Ford Motor Companies at a loss, I cannot buy back into Ford Motor Company within 30 days or it negates that tax loss. And so in essence, I could go buy General Motors as an example. That's a different investment, although it will likely have a similar attribution. Or probably a better example to use is I'm invested in large cap stocks through an index like the S&P 500 index. I can sell out of that and move into the Russell 1000, which is another type of large cap index. And I can, if my S&P 500 position is down, I can realize that loss for tax purposes, move into the Russell 1000 for 30 days, and on the 31st day, I can move back into my S&P 500 large cap. We take this actually a step further. For some of our clients that have accounts large enough, we actually do tax loss harvesting every month with a strategy that is referred to as direct indexing. What direct indexing does is it takes tax loss harvesting to a whole nother level, where if we're talking about the Russell 1000 as an example, there are 1,000 stocks on the Russell 1000 or 500 stocks on the S&P 500. This year is an absolute perfect example of where direct indexing really benefits our clients. Because for accounts that have a certain size, we can own basically most of the stocks on the S&P 500 directly. We can create our own index that mimics the performance of the S&P 500 by buying pretty much most of the stocks within a certain tracking error. And this year, the S&P 500, as of the date of this recording, is up approximately 20%. But there's only 7 stocks that are really driving that performance. They're called the Magnificent Seven. The other 493 stocks are actually down as an aggregate. So if I own the S&P 500 index fund, I'm up 20%, which is great. But there's nothing I can do to tax loss harvest those 493 stocks that are down. If I actually own the 500 components of the S&P 500, I could be selling those 493 stocks at a loss, realizing that for tax purposes, and still have pretty much the exact same performance of the S&P 500, but now have what we call tax alpha in that portfolio. So we actually use that for most of our clients at a certain account size that are in a non-qualified investment account, non-qualified being that it is not in an IRA or 401k or Roth IRA. That's typically an ERISA type of or an ERISA type of product. But in essence, that's what tax loss harvesting is. is we intentionally are booking losses for our clients so that it benefits them tax-wise, either to create a loss carry forward that they can use to offset gains in the future, or they can take an income tax deduction on their tax return up to $3,000. So that's a little bit about tax loss harvesting and how we implement that for clients throughout the year.
Well, that's great. That's a great explanation. Thanks for going into the extra detail with the direct indexing. I know that is something that we've implemented here, and it's been very valuable for our clients as we try to meet with them multiple times a year to really understand what they have going on from a tax perspective in coordination with their CPA. Another great strategy that Instrumental Wealth, we really work with clients, diving deep, helping them with their financial planning. And if that this topic was interesting to you, or you want to learn a little bit more about it, maybe you've never heard of either tax loss harvesting or direct indexing, we'd love to chat with you. Just reach out to our team, connect with us on social media, and we look forward to chatting with you very soon.